Hello, everybody. Thank you for joining us for today's webinar. I'm Ric Edelman, and we're really excited to be presenting this webinar for you. There's been an awful lot of attention with what the so-called Trump trade ever since the election. The markets have been performing extraordinarily well, but in the midst of all this, we can't lose sight of the fact that something else is going on in the economy. Interest rates are declining. The Fed most recently announcing yet another rate cut. And in the midst of all this, if you are seeking income from your investments, if you're a financial advisor trying to help your clients who need income from their investments, how do you generate that income in a world of declining rates? Something that we're not terribly used to. So to help us delve into this and understand what the strategy ought to be, I'm very happy to be joined by two of our friends from Invesco, Reyna, who is the head of thematic and specialty product strategy, and John Burrello, who is the portfolio manager for Invesco's global asset allocation team. Gentlemen, join me on the program.
Hey, Rick, great to be here.
John, Rene, good to have you both. Everybody I think is very familiar with Invesco. So just for kicks, tell us, for those who really need to know the Invesco story, tell us a little bit about the company.
Sure. I mean, I can go ahead and start there. So we are a global asset manager with approximately 1.7 trillion in assets under management. Our sole focus is managing assets for investors. We have a variety of investment products in both active and passive. I know one of our focus really today is around the ETF side, and we look at that part of our business. We've really grown. Our ETFs now are over 600 billion in assets under management across multiple capabilities, both passive and active. And we're excited to participate on today's call.
It's no secret that Invesco is one of the biggest, largest, oldest, and most influential ETF and asset managers in the marketplace today. So I'm really glad that we're here talking about this topic because it's getting overshadowed by what's going on in the world of crypto, what's happening with the president-elect's appointments that are coming out, pretty much hourly, with who's going to be running the government in 2025 and beyond. So it is really important that we remember that ordinary investors are still dealing with every daily issues, and it's been a while since we've had a declining rate environment, but that's kind of where we are today. And it's a bit of a challenge when you've got interest rates coming down, but inflation remaining pretty steady. So what I've found interesting, and the reason we wanted to have you joining us, and oh, by the way, I should point out for everybody watching this that you have the opportunity to ask questions. Go into the Q&A box, and as our conversation develops, if there's something that triggers a question in your mind, just post it there. I'll be curating that as we go through today's conversation and peppering them throughout our dialogue. Tell me, Rene, about the new products that Invesco is offering into the marketplace to help deal with the issue of generating income in today's economic environment.
So I'll start off just talking a little bit about a derivative income ETF. So we launched 3 strategies back in July, and I think maybe it would help for those listening today just a little bit about sort of what they are. So I'd say a couple of things. One, when we look at this category, sort of use terms sort of interchangeably. Sometimes we're referred to as option income ETFs, derivative income ETFs. Sometimes people just call them covered call strategies. They're all sort of the same group. Morningstar actually has a designated category called derivative income ETFs that we sort of use to sort of assess this marketplace. But these types of strategies or this environment, why they could be useful in a portfolio is generally these types of strategies will use derivatives such as options to generate additional income. So we typically see in this marketplace covered call strategies or put writing strategies to enhance income. And effectively, this group of ETFs will, so I think of the covered call side, for example, you'll have a stock or a basket of stocks, you write options against those, and you generate premium income. And so really an attractive way to boost overall yield. If we look at some of these put strategies, similar approach, put writing, selling options, and then generating additional income. And so, why consider this in sort of an ETF? I think, a couple of things. So one, these option strategies generally offer higher yields. So if I compare it to investing in bonds or dividend paying stocks, I can get sort of a premium income or elevated yield, if you will. I think the other part is if we just sort of think of the value proposition of these types of strategies, I can get and maintain market exposure. Via options, I can generate additional income. I can gain some downside protection. And I think that value proposition is probably why we see a lot of growth in this particular space, and is more of the reason why we looked at bringing this type of capability. I think the other side is, I talked a little bit on the opening question about Invesco and ETFs. I think this is a marketplace that just continues to grow. And we look at the last 15 years, for example, globally, it's now a $14 trillion market. It's grown at approximately 20% compounded annual growth rate over that time. I mentioned sort of our size of our business. Our ETFs have grown about 22% over that period. I think also interesting trends as we see investors' demand for ETFs increase. There's sort of this active side. We look at launches this year, for example, about 74% of all new ETFs that are brought to market are active. And I bring that up because I just talked a little bit about derivative income ETFs. When we look at this sort of cohort or segment of strategies, 75% of them are active. So you hopefully get a sense of maybe how these could fit in a portfolio, but more importantly, some of these trends that we're seeing in this particular space.
So there's a lot to unpack in there. That was great info, Rene. Thank you. But let's break it down into a couple of major themes that you just highlighted. Number one, you said that one of the advantages of the covered call strategy, for example, or the put strategy, is that it generates additional income. Elaborate a little bit on how much income are you talking about as a percentage of the portfolio or percentage of the investment, and how does it do that exactly?
Yeah, great question. So generally speaking, I would say there's a couple of components to this, right? So maybe for the audience as well, so just sort of think through of what we brought to market. So we have sort of these flagship indexes. So think of the Qs, for example, the second highest traded ETF by average daily trading volume. You have a passive capability that investors are more familiar with. We have a capability in-house on the active side with our global asset allocation team, where they've been sort of managing these option income strategies for quite some time. So you overlay that on that particular index, and it's really about how do you find the right balance between income, market participation, and risk mitigation or protection. And so if you think about those sort of three tenets, we took a very sort of thoughtfully designed approach. I know, John Burrello on the call here as portfolio manager will dig a little deeper into that, but effectively, it's really cool because they have this database. So they've been doing this strategy since 2018. So they offer it on the mutual fund side. And as you think about all the various sort of characteristics or outcomes you look at an option strategy, what they were really able to do is say, hey, look, if we want to provide consistent and reliable income, what are some of these targets we can confidently achieve and be able to deliver those outcomes? So I mentioned the Qs, so taking that index and overlaying it with an active options income overlay. That strategy, we're targeting a 10% distribution rate. So if I look at since launch, we've been maintaining that. We took another index. So this process, which again, John will talk a little bit deeper about, we can apply it to multiple strategies. So we also looked at S&P 500 equal weight. So the ticker there is RSPA. Similar approach. Half the portfolio is passive. We have the active options income overlay. There we're targeting and currently delivering 9% distribution rates. And then there's, we looked at a bellwether international index, so the MSCI EFA. That ticker is EFAA. Similar approach, and we target and are distributing about an 8% distribution rate. So I think really it's about the process that's been employed for quite some time that John and his team manage. But really, it's all about trying to strike the right balance between income, market participation, and defense. And because they've been doing this for some time and they have these capabilities to model and backtest, we feel very confident about maintaining sort of that income consistency and reliability.
So I'm just trying to understand the parameters of this. I mean, 10% income distribution sounds pretty appealing in a declining rate environment. Nobody's going to earn that in a T-bill these days. So 8, 9, 10% income streams sounds very strong. The way you achieve that is by writing these options contracts, which means that on the thinking worst case scenario, the stock rises in value, the option gets exercised, and you end up selling the stock, but you're selling it as a profit. So that's not a terrible tragedy in my mind. John, doesn't that seem to make sense? I mean, that negative scenario doesn't sound all that negative, does it?
Well, actually, Rick, yeah, I mean, you could actually take it a step further with the way we've designed this suite of strategies. So, I should mention up front, QQA, RSPA, and EFAA, when we're talking about the process, it's identical across all three of those ETFs. So we've just ported it onto different core trusted indices. But the option overlay, we utilize index options, which are cash settled in nature, which takes exercise risk off the table. That means we're never forced to sell any of the underlying holdings within the equity portfolio. So there is no concept of exercise or being called away or put the stock to us with the option strategy. But to your point, if the market does rise quickly, we won't capture all of the market upside. And so we try to be very thoughtful in the portfolio design to maintain significant equity market participation. These are still equity strategies at the end of the day. We're never fully capped, and we're always adapting so that we can maintain upside as the market is rising over time.
And if the markets go the other way, so you're saying that one of the negatives here is that if the markets rise, you won't enjoy necessarily or potentially all of the upside. You'll get some of it, but not all of it.
Yeah.
You're willing to tolerate that in exchange for the 10% income you're getting. If the markets fall, however, what happens then?
In falling markets, we are highly likely to outperform the benchmark indices. And that goes to the original portfolio construction. These portfolios are structurally defensive because we use zero leverage. And remember, we're collecting all that income regardless of what the market does. So if we collected the income and the market falls, we have a bit of a buffer there to protect against downside risk. Similar with flat markets, we expect to outperform if the market stays flat for the same reason. And then there's an element of where exactly do you strike the options? If we're trading options that have also a downside buffer embedded in them just by way of where we've set the moneyness of puts or calls, that also impacts defensiveness. At the end of the day, you can expect our portfolios to have a beta profile that lives in the 0.75 range. So that means 20 to 30% less risk than the broad markets. Again, highly likely to outperform in down or flat markets.
Now, I know we're already getting a lot of questions from folks, so this is something of really a great level of interest to folks. And you mentioned three, Rene and John, you both mentioned three different ETFs that we're talking about. You've got a lot of information, a lot of background that people want to digest. We are going to issue out to you, go to your link here in Zoom, and we're going to push out to you a bunch of documents that come from Invesco to give you a lot of this background information for you, including the three different ETFs, their ticker symbols, and all that kind of good stuff. But one fundamental question I know that people are going to be asking, in fact, I see one already being asked. You've got three different ETFs you mentioned. You're engaging in this option strategy with all three. One of them, Rene, you said is currently generating a 10% income stream, another one 9%, another one 8%. Why would anybody choose the 9 or the 8 if they could choose the 10? So explain the difference between the three and why you have those differences.
Well, I'll start off, and John, feel free to add where appropriate. So if you think about the portfolio, so I mentioned earlier, you sort of have half, so 50% of your portfolio is going to be long index exposure. So you think of the Qs and sort of the profile, performance and risk profile that comes with that portfolio. Your volatility is also going to be very different compared to something like the S&P 500 equal weight index. So if I just think of those components for a moment, the long only portion, I may be using it in a portfolio for very different reasons. One, I may be looking for more growth and/or taking on some more volatility, which should therefore be more income. So that's where QQA at a 10% will come into play. If I'm concerned about concentration risk in the marketplace, I may want to take a look at something like RSPA. So I'll have 50% S&P 500 equal weight exposure with that active option income overlay. The other side of the spectrum is international equity, a space that we all know is inherently more volatile. And I think for investors who perhaps want to either enhance income or sort of improve their sort of risk profile, I think that's another way where you can sort of tackle that segment of a portfolio. So these are very sort of, if you think about the long only portion of the strategy, you can start thinking, one, kind of where I may fit it in a portfolio, but then two, because the volatility profiles are very different, I can see sort of the trade-off or sort of the income boost I can get based on that. So that's kind of how we think about how to select one of the three strategies.
John, you want to add anything to that?
Yeah, I mean, maybe to summarize, it would be almost the same decision process you'd go through when you're deciding, do you want to own NASDAQ 100 exposure with the Qs? Do you want to own equal weight S&P or MSCI EFA exposure? At the end of the day, these are still equity-based portfolios. That's going to be the core in terms of driving your total return expectation. What kind of strategy do you want to have exposure to? The option income overlay, we were very thoughtful about those targets. So, QQA at 10%, that is justifiable because we have a very strong growth engine under the hood with the NASDAQ 100. And when you look across asset classes, what's key is to balance yield and growth. We want our growth participation to be, and the total return of the strategies to be able to exceed those yields. Otherwise, you're setting the portfolio up for NAV erosion in a falling ETF price. So it's really important when you look across the option income space to see, was this product designed for total return and the growth of capital in addition to distribution yields that are attractive? And in our case, we put a lot of thought behind that when we landed on these different yield targets.
So Mike has asked a question here. Can you tell us about the tax classification of the income? Is it qualified dividends, cash dividends, interest? What do you call these things?
Yeah, it's a great question. So we, first of all, the equity dividends that are distributed, that'll account for between 10 and 25% of the overall yields. Kind of depends on the market. For the NASDAQ 100, for instance, the dividend yield is pretty low. So that's only going to be about 10% of that 10% yield. So only about 1% is coming from dividends. For EFAA, it's a bit different. It's a higher yielding underlying index. So it'll be closer to a quarter of the overall 8% yield is coming from dividends. All those dividends are qualified to the extent that the stocks are distributing qualified dividend income. So we're not impacting the treatment of dividend income. On the option overlay piece, that distribution is treated as interest income. So it's pure bond-like interest income. That comes from our choice to implement the option overlay through equity-linked notes, or ELNs. There are a couple of other players that have designed the strategy in this way. We and our tax advisors believe that this is an efficient way of distributing the income that doesn't have some complex issues that you can face if you are distributing pure capital gains on a monthly basis. So the easy way to think of it is about 75 to 90% of the yield is coming as interest income like a bond. The rest is qualified dividend income.
Brandon is asking, I think, the real key question here. There's never a free lunch, he says. So these distribution yields sound great, but how would you describe the potential risks to a client?
Sure. Risk management starts with product design up front. So a couple things, liquidity, big consideration when we're designing products. That's why we only pick underlying assets that are highly liquid. We're talking about the NASDAQ 100, the S&P 500 equal weight, MSCI EFA, big, widely traded exposures. So liquidity, we feel we've addressed just by dealing with assets that already have very active marketplaces in derivatives and in the underlying stocks. But second, a big consideration is leverage. When people think derivatives, a lot of times you think, well, geez, is there blow up risk here, or can there be issues if we get a really, crisis situation? Well, we deal with that up front as well by always being fully collateralized, fully covered, essentially in a de-levered position. Again, back to our beta profile of about 0.75, we're going to be defensive and positioned well to outperform even in the most severe market scenarios. So in terms of risk, we get asked a lot, what is the worst case scenario for these products? It's going to be a very sharp rising market where that beta profile that I've mentioned a couple times, called about 3/4 of capture, we won't get that much capture if the market is jumping double digits in a month or a quarter. It's going to be more like 60-ish% capture in that type of an environment. So going in, we try to build these strategies to be easy to understand the expectations in down, flat, and up markets. But yes, there is no free lunch. We're giving up some of that sharp upside exposure.
And what about the sharp downside? If the markets fall dramatically in a short period or even extended, what's the impact there potentially?
Again, because we're starting in a very defensive, de-levered position with the option income acting as a buffer, we're likely to outperform in down markets. That capture ratio should be in kind of the 80-ish% range in the worst case scenarios.
You mean you'll lose 80% of what the market's losing rather than what the market is entirely losing?
Right. So in other words, outperforming by 20%.
Right. So just to make sure everybody fully realizes, you're not saying you're not going to lose money in this fund. You're
Correct.
simply saying you might lose less.
That's right.
So congratulations, Molly Brown. You have the best cabin on the Titanic.
Right.
So it's important to frame that correctly so that people have proper expectations. As we all know, the worst thing is when a client has false expectations leading to disappointment. So it strikes me as a good risk reward parameter because you're limiting the downside risk, which you're exposed to anyway, and you're limiting the upside potential, but you're not doing this for upside potential. You're doing this for the income generation that you're seeking as a retiree, and getting 8, 9, 10% income streams. That's a pretty powerful message for somebody who's in their 60s or 70s looking for income. So I think it makes sense to have a good balance there.
Yeah, I mean, our hope is to be able to win by not losing as much over the long run.
That's a great way to phrase it.
Yeah.
Rene, I want to go back to something you said because we talked about parsing out your opening comments, and you said one thing about active management that I really want to highlight here, because we all know the storyline in the investment management community for the past few decades. The data has been very clear. Passive beats active. That has been the message that we have seen from all the Morningstar data, all of the analytics, all the academic reports that we have seen shows that active managers, regardless of asset class or market sector, regardless of where you are in the Morningstar style box, active managers generally have been unable to outperform passive indexes. And in fact, Invesco has been among the champions of passive investing. Look at QQQ as perhaps the best example of this. You buy a broad index, you create one intelligently, you keep expenses really low, you minimize turnover and therefore tax exposure. What's not to love? but you mentioned that these have an active component. And I have two questions here related to this. Number one, you kind of have to have an active engagement, don't you? Because you can't do this kind of options trading passively, because by definition, you're constantly having to buy new contracts. Options expire. And so active is an inherently unavoidable element of this strategy, isn't it?
Say so. I mean, so there are sort of these option indexes that exist that certainly you can track. But I mentioned earlier one of the stats when we look at this space, 75% of it is active. And I think the one thing when I think about sort of the active component of the derivative income category, I'd say a couple of things. Is one, just to kind of put in perspective as well, it's a space that has grown pretty massively, especially over the last 5 years. So when I look at flows, for example, 5 years ago, you probably saw about 500 million coming into the space in that year. Fast forward to year to date, we're seeing over 24, 25 billion that's come into these particular strategies. We also look at the number of capabilities that exist. 5, 10 years ago, there was probably, 13 different strategies. I looked through the end of October, there were 105 funds that now fit into this derivative income ETF category. 35 or 36 were launched this year alone.
Wow.
And so it can be perceived as somewhat noisy. And I think what we try to do, when you think of going back to your comment or question around active, is one, thankfully we had capability in-house. John and his team were managing sort of these same type approaches. He mentioned with all three of the ETFs, we employ this active options overlay. They've been doing it on the mutual fund side. But then you mentioned some of the trends that we are seeing. So it probably made sense to start looking at ETFs. When we look at this category, though, we sort of think of it sort of like 1.0, 2.0, 3.0 versions. So historically, this has been sort of covered call based strategies. You try and target a high yield and deliver that on a monthly basis. The problem, like John mentioned, is you generally get sort of NAV erosion. Not to mention, in some cases, to maintain these attractive yields, you have to return capital. Maybe not the worst thing in the world, but create some nuance, especially come tax time. I think we've then seen the marketplace evolve, and I would say it's sort of like twofold. One, we see sort of these single option strategies that are basically taking a stock and employing sort of covered calls, if you will, generating very attractive yields. But again, you run into the same sort of problem, NAV erosion, your total return profile may not be attractive. The marketplace has evolved, and where we see assets going today are a little bit more of these sort of balance approaches where especially, John mentioned using ELNs. When we look at the flows going into this space, 50%, over 50% of the assets are going to strategies that are employing their option strategy in that sort of capacity. And what we're able to do is sort of have the fortune to look and assess the marketplace and say, well, what are still some of the challenges, or where can we add value? So you're going back to active. I think that really came down to the fact that this team's been doing it for so long, and they have over 3 billion inputs. So think about this database and being able to sort of model and say, how can we confidently achieve this? And so we're using both calls and puts, so that helps with the income profile. But when you start talking about strike prices, which is another sort of value proposition that John can talk about, we found a way that we think, we feel confident that we can accomplish those yields. So sometimes we refer to, when we talk to clients, we'll talk about sort of the common pitfalls we see in the option income space. It's more about education, just really trying to say, hey, look, not all of these 105 strategies that now exist are the same. And so if you value more of a balanced approach, the consistent and reliability of income, market participation, and downside protection, what we're offering in the marketplace, hopefully you'll see us sort of differentiated, but then addresses some of these common pitfalls that we see in the marketplace.
You want to elaborate on that, John, regarding the strike price?
Yeah, so it goes to consistency, and actually, when we think about design and the way that the process works with strike prices or the type of options, our starting point is always, what are the outcomes we're trying to drive here? It's not how do we develop a cool covered call strategy to get into the derivative income space. Options are just tools to drive outcomes. So when we think about the balance of income, participation, and defense, we want consistency in all three of those incomes, or all three of those outcomes rather. Income being really important to be consistent. So the more common approach in the option income world is to have consistent strike prices. So you're always selling an at the money call, or you're always selling a call that's a certain moneyness or delta target or something like that. But at the end of the day, clients don't experience consistent strike prices. They experience consistent yields or consistent market participation. So that's what we're after. When you adjust the strike prices of the options through time, we can eliminate one of the really common pitfalls with option income strategies, which is that the yields start to fluctuate with market volatility. And you get a high vol market, you're in crisis mode, option prices jump, and so do your yields. Well, then you have to live with the flip side of that too. When markets calm down, your yields get cut sometimes in half or even more. So the way to avoid that is to have a systematic process like we do, where we're adapting the strike prices of the options on a daily basis. We're resetting a portion of the portfolio to react to market conditions. And basically, we're asking the option markets a question each day. We're saying, to achieve my yield target today, where can I set my option strike prices and still get that yield? And so it's no more complicated than that. The market is driving where those strike prices go, but we like that because that means that in higher volatility markets, we're pushing those strike prices further away from the current market price, which means more defensiveness and more upside capture. And that's a beneficial thing to have when markets get really uncertain. You want better participation profiles. So this process of adapting the strike prices and not aiming for always the same option strike is what allows us to have consistent yields through time and also consistent market beta.
And I want to ask you the same question I asked Rene about this concept of active versus passive. I think one of the reasons that passive has done so well over the past several decades is because the economic environment has been relatively calm, relatively stable. And it was kind of hard to deliver value from picking stocks compared to just buying a stock index. But we are now in an environment we're discovering where there's a huge amount of dynamic activity going on, not just politically and through geopolitics, but through technology, the advent of AI, obviously, the development of crypto and blockchain technology, the now dynamic movements of interest rates. We went through 30 years of declining rates, and all of a sudden we had rising rates, and now they're declining again. We haven't had this kind of interest rate volatility in the careers of most of us. So it's hard to argue that you can just sit back passively in an environment that is now dynamic. And I'm wondering, is that perhaps opening a door to active management that didn't really exist through the 1980s, 1990s, early 2000s, and allowing for the creation and development of a product like a product set that you're now offering that 30 years ago wouldn't have been needed, quite frankly. When you had, double-digit interest rates, you didn't need a 10% option strategy because you got it from a T-bill. So what's your reaction to what I've just said?
So I would agree. It's a highly uncertain world, whether you're looking at equities or the interest rate environment. It's really hard to predict where to be, or how to, what the next 5 years are going to look like. So when we design the income advantage ETFs, these are ways to help people prepare for that uncertainty. So, for instance, if you already own QQQ and you're a little bit worried about, extended valuations or concentration risk at the top end of the market cap spectrum, which is obviously on everyone's mind, or you're entering a phase of your life where additional income and defensiveness would be helpful to your portfolio, QQA is a way to de-risk a bit. So if you own the Qs, you still want exposure to the NASDAQ 100, you can take some of your foot off the gas, de-risk, add that monthly cash flow that's not sensitive to interest rates. So that's key here. It's zero duration income that really doesn't care what the Fed is doing or what central bank policy looks like. So these are the outcomes that we're allowing our investors to choose between. It's a serving a value add proposition there. But to your point, active versus passive. On the passive side, we've actually combined both of those elements in these products. We do not manage the equities actively. We're simply replicating the NASDAQ 100 as the base equity portfolio in these strategies. We think that's really important because the options we're using are NASDAQ 100 options. And we don't want a mismatch between the equities and the options. It's really important to have a pure exposure between those two elements of the portfolio. Now, the options side lends itself much more to active management. To your point, Rick, you brought this up. We're resetting strike prices on a daily basis. We're doing it systematically. So we have a process that's very well defined, but we think it makes sense to have professional investors who spent their whole careers managing option-based strategies looking after that overlay component rather than an index that may have been designed years ago without even contemplating the environment that we'd be in today and kind of how the dynamics of option markets work.
I think it's interesting what you just said might be a point everybody's kind of ignored. This is an income-oriented ETF that doesn't get its income from bonds.
Yeah.
It's getting it from equities in a weird, indirectly through the options. So that's a really fascinating alternative that I think most folks would be surprised to really think of. If you went to a client and said, I want to generate for you a high level of income and it's not coming from the bond market, I think that's a surprising comment to make.
Yeah, I think you can even take it a step further, zoom out even more, and look at income from bonds or from dividends on stocks. Those cash flows, that source of income is coming from economic activity. With option income, it's coming directly from the capital markets. So we actually, the income we're generating has nothing to do with what the economy is doing or what the central banks are doing. It's available directly from traded markets and essentially monetizing uncertainty in markets as another complement in terms of income and cash flow to our broader client-based portfolios.
So Rene, let me go back to you with another big picture question. To what degree or how best do these derivative income ETFs fit into a broader portfolio that is an income-oriented portfolio? How much you'd be putting these into a portfolio? What percentage of the allocation?
Well, actually, and I think too, maybe before I answer that, just something that John mentioned that hopefully resonates is that the income here is structural, it's contractual. So we think about interest rates, you remove sort of that interest rate risk when you think about approaching income this way. I think to that end, so I sort of first think of it, and I saw some of the questions come in around type of accounts. I want to address that too in this answer. With those high distribution rates, if you're concerned about taxes, a qualified account will certainly be more appropriate. I think if you're already, some investors are taking income in their non-qualified account. So if you're experiencing that, it may not be much of a difference. I just wanted to point that out to kind of how to think about, sort of qualified versus non-qualified. And we see investors use them in both ways, again, depending if you're in the distribution phase or accumulation phase, if you will. Taking a step back, though, in terms of thinking, how do these fit? Where sort of do we take assets from in a portfolio? So we just think of various scenarios. So if I just take the equity component for a moment. So John mentioned this. We have all these various sort of macro environments. I may own the Qs today. And I may be concerned that you've mentioned this to kick off the call. We've seen a pretty strong run up, not only this year, but post-election. So, the question is towards the end of the year, do I profit take? Do I maintain exposure? if you're looking to sort of reduce your exposure or profit take, but you still want to maintain exposure to the Qs, I think this is one way to sort of take some risk off the table while maintaining that exposure. Said a different way, if you were on the sidelines and looking to sort of ease your way in and maybe just concerned about valuation, so you have a view, I think this is a way to sort of get that exposure while getting sort of paid to wait and then having some of that downside protection. So what that will tell you is that, you know, generally speaking, if you think about the Qs or RSP, those are generally found in the core type of portfolio. So from your core, you know, you can start paring back a little bit if you're looking to take some risk off the table and you're okay with those distributions sort of getting paid to wait. The other part is around, you know, clearly around income. So we are in an environment most likely where you know, interest rates should be coming down. And if I just look across an income model or an income component of my portfolio, I think this is a great way to sort of diversify that a bit. So if I want to sort of increase my yield profile, or we talk a lot about the consistency, you know, the challenging part sometimes about a model is yields change. So I may own a high dividend paying strategy. To no fault of my own, the distribution policy may change. You know, you may see some sort of variability in terms of that dividend income, or on the bond side, I may have bonds come due, interest rate risk, or just generally see interest rate risk sort of with bond investing. So this is a great way to sort of supplement that. So I can now take my income portion of a portfolio of a model and perhaps use this as somewhat of an anchor to sort of achieve that targeted yield that I may be trying to achieve. I'd say those are two of the sort of most general forms to think about using this strategy. Outside of that, it's really more model driven. So I might be owning a multi-asset portfolio. I may have a 60-40 strategy. I think this is just perhaps a enhanced way to pick up additional income while sort of maintaining that equity exposure, if you will. And those are sort of three general ways I can, you know, see this being used in a portfolio. I mean, John, I don't know if there's anything you wanted to add to that. I mean, I know we have a lot of, you know, great conversations with clients, both retail and institutional, as they look into potentially allocating a strategy like this. But John, anything you wanted to add to that?
Yeah, I mean, I think you covered kind of the three main ways we see people using the strategies. One is de-risking it in your existing equity allocation. Again, take some risk off the table, do that structurally, reliably because of the option strategy. It's different than a low vol equity strategy in that regard because it's not a statistical assumption about what the stocks will do. We've baked in defensiveness into the process, plus that additional income. The second use case is more income focused. So, you know, in an income model, you can look at high yield bonds. You know, sometimes can be an equity-like volatility to that asset class, and you get that attractive income. This has a similar kind of risk profile to some higher risk bond portfolios to add a higher income element. And then lastly, that dividend portfolio complement these strategies can serve well as a complement to those.
We've gotten a bunch of questions. Let me give some of these to you rapid fire, John. First, at the end of the year, do you get a K1 or 1099?
1099.
So it makes life much simpler because at the end of the day, they're just ETFs. So
correct.
You don't have to worry about the rest of it. The expense ratio?
For QQA and RSPA, it's the fee is currently waived through the end of the year. After the end of the year, it'll be 29 basis points for each of those. For EFAA, also waived to the end of the year, it's 39 basis points starting in January.
So I don't think fee is going to be a particularly relevant factor in the decision whether to do this. This is, you know, they're market competitive for sure in the ETF space. Gary asks, how reliable are the distribution yields you've quoted, and are they paid out how? Monthly, quarterly, annually?
We've designed them to be reliable and consistent, so we expect to maintain similar levels across market environments. We've made in QQA and RSPA, so monthly is the answer. That's the frequency. We've made 4 distributions so far for QQA and RSPA, 3 for EFAA. You can see if you look those up, they're all consistent, kind of in the same range, right on our targets.
Several folks have asked for the ticker symbols, etc. Go to your chat box at the bottom of your screen, and you'll see a link that we have just pushed out to you that takes you to a lot of content from Invesco that will give you a lot of great detail about these 3 ETFs. We've just pushed it right out for you right there. Tom asks this, and Tom is a pretty knowledgeable guy from the nature of his question, so I'm going to ask you to elaborate on what he's talking about before you answer it. He wants to know, what is the difference between QQA, which you have talked about, and QYLD, which you have not. So tell everybody what the Q yield ETF is and how it differs from QQA.
So I'll give some high-level comments around this because QYLD is a competing ETF that is passively managed, that is tracking a NASDAQ-based covered call index that was created by the Chicago Board Options Exchange. And I'll just make comments that apply to this one, but also just more broadly. A strategy like that will not be diversified on the option overlay piece. And what I mean by that is they'll sell one at-the-money covered call position on the 3rd Friday of a month, and then they'll roll all of the option overlay at the same time at the next 3rd Friday of the month. We think diversification of option overlays is just as important as diversifying your stock portfolio or any other sort of asset class that you're building a portfolio with. So we actually ladder our option positions every day. Call it 20 business days in a month. We have 1/20th of the exposure that's being rolled each day. And that removes the element, as much as we can, the element of path dependency from the strategy. So an approach that's passive and only trades once a month is going to be more path dependent on the day they trade and the day they roll the options than a strategy like ours, where we try to smooth the profile through laddering. Now, another thing I'll mention as a differentiator here that applies to a lot of other option income strategies out there is that if you're capping all of your upside, selling calls on the entire value of the portfolio, your beta profile is going to be lower. And so I think the beta profile of that type of covered call strategy would be more like 0.5. Ours is more like 0.75. So we're going to have more upside potential through time, and will be less likely to have a declining NAV through time. So I would encourage you to look at whatever the option income ETF you're looking at, check out its ETF price. Is that price falling even though the market's rising? And if so, that might mean that it's distributing too much income to justify its level of yields. You're essentially getting return of capital instead of capital growth.
And that can be very misleading or deceptive, not in a nefarious way, but just people are not used to getting return of capital from an ETF, and right. And they don't realize what's going on when that occurs. It's a common pitfall. Jody asks a really good question. Advisors are always trying to segment the portfolio, Rene. They're trying to figure out, should the client own a 60-40? Or a 70-30 or a 50-50 portfolio? It's a pretty fundamentally important question in portfolio construction. And what Jody's asking is this: these new ETFs, are they representing a new category that are not really properly fitting in the 60-40, or would you put them in there, and which would you? Would you put them inside the equity allocation or the bond allocation?
So great question. So I think you can generally make a case for both. And so when we think, so I'd say, even I'll take a step back and say, when it comes to allocation of a portfolio, I mean, we have the easy job here to talk about our products and sort of high level around these strategies. As you work with your advisor, that's really sort of the main person that you want to have these conversations with to sort of determine sort of those proper allocation questions. When we think about how these strategies fit sort of in that sort of construct, I think that's where, when I think about a 60-40, generally speaking, it's allowing you to maintain equity or market exposure. So still have sort of a growth component, while having, fixed income to generally sort of protect on the downside, improve or reduce sort of correlation, and maybe even sort of generate income. These strategies in a way are sort of a bit of a tweener in the sense that, when I think about a 60-40, if I'm looking to reduce sort of my risk on the equity portion, I can sort of peel back a little bit of exposure and then use this as a component of that. Same thing on sort of the fixed income component. I may be targeting a certain yield profile with that 40%. And again, every investor's objective is going to be different. I can perhaps use that to achieve that higher income. At the end of the day, if you think about the beta profile here, what a 60-40 does is sort of reduce your sort of risk profile. What this strategy inherently does, by the virtue of how it's constructed, is also sort of reduce that risk profile. So I think the trade-offs, hopefully we've sort of made a case about some of the trade-offs that exist in a portfolio, but they definitely can serve as an enhancement to sort of that 60-40, probably fit more closer to the equity portion of that. In terms of new category, I mean, yeah, I think this is where the good news is there is a defined category. So I imagine the conversations will continue to evolve. Keep in mind there's other types of strategies that sort of exist in sort of this option area. Think more sort of option trading. You can start talking about just strictly hedge portfolios. So there's a variety of strategies that are a little more different than your traditional sort of equity and bond portfolios. And I think the marketplace will continue to sort of segment and allow you as an investor to sort of evaluate and at least sort of compare and contrast the differences between one or another.
Yeah, I think you're absolutely right about that. I mean, this clearly isn't a bond, so it doesn't really belong in the bond category. It is fundamentally based on an index of stocks, that's equities. And the fact that you're generating income off of that through options trading, well, that's not a horrible extension from stocks that pay dividends. I mean, it's just another income opportunity from the equities market. So I would probably put them in the equities side if I had to choose between the two. That would just seem to make more common sense to me. But I don't know that it's a right or wrong answer at all. Rene, another big picture question. We've talked about how these work, how they can be beneficial both in IRA accounts as well as taxable accounts, the degree to which you should incorporate them into a diversified portfolio. Talk now about the kind of investor who's best suited for a derivative income ETF.
So I think that the good news, and if you think about sort of what we just talked about today, I do see they're sort of evergreen. I think in any given scenario, there could be a fit. So I would just say that more broadly. I think about the sort of applicability. So if there are certain outcomes I'm trying to achieve, and some specific ones may be more on sort of the distribution phase of an investor. And so I may try and match a certain liability. So I may have just to throw out an example, there's so many different examples you can use here, but let's just say I have a long-term care facility payment I have to make. I can sort of say, well, how much income do I need? How much capital, if I use a strategy like this, to generate that income? And I can, if I'm going to have a consistent monthly income stream, generally reliable, I can perhaps use this as a way to sort of match that liability. So, the distribution phase, certainly, I think just, general supplementing income, which a lot of investors who are in that distribution phase may be looking for different sources of income. And I think this can certainly be one. So, I think that's something also to consider when you're thinking about where I can use in sort of practical sense some of these strategies. And because of that income component, the distribution phase, tends to stand out a little bit if I'm an investor trying to figure out where to incorporate a strategy like this.
Yeah, I think that approach makes a lot of sense. Have a goal in mind, a need you're trying to fulfill as a way to allow you to reverse engineer this to determine what's the amount of principal you'll be putting into these ETFs to generate the income you need to pay a given bill or maintain a given lifestyle, et cetera. That makes an awful lot of sense. We've only got a couple of minutes left. This has been incredibly good info and tons more questions. There's a lot of interest in this from everybody watching us here today. Yet these are different. These are not your, ordinary everyday stock or bond ETFs. Investor education is needed here. So can you talk a little bit, either of you, John or Rene, about the investor education, advisor education materials beyond what we pushed out to everybody here in the webinar? What do you offer advisors and investors so they can learn more about this whole concept?
Sure. Well, I'll start. I mean, so we've definitely, as a firm, have dedicated a lot of resources to these particular launches. So, for example, if you were just do a Google search of Invesco Income Advantage, it will take you to a landing page with a lot more information on these strategies. So that's one part. Thing two, we're continuing to build upon that. So we understand and recognize that these strategies are a little bit more complex than traditional sort of long-only funds. And so what you'll notice over time is an increased education, whether it's market material, videos. I know John worked really hard to create a white paper, which I can let him talk about here in a moment. So there's, from an education standpoint, there's that. If you're an advisor on this call, I'd encourage you to reach out to your Invesco representative. We have a team of consultants, ETF specialists. Their sole purpose is to help with that education part. I know I have a team of ETF strategists and analysts. John has a team of portfolio managers, client portfolio managers to help with education as well. So there are a variety of options. Start with the material that are provided today, and then you can kind of go from there. I mean, John, anything I missed out you want to add to that?
I think you covered it. I mean, we've got a lot of digital assets that you can find through the Income Advantage dedicated webpage. And then, the entire full force of Invesco professionals are behind this and able to help out with any questions. So we definitely encourage you to contact anyone you know at Invesco to dig in deeper. But you're right, Rick, like education is really important with these strategies, and the approach we've tried to take is to not just educate on our particular products, but how to think about option income as a portfolio tool and what to look for when you're assessing this space.
Well, I want to thank you both for joining us for this webinar. Terrific content, great information. I think it's going to generate a lot of questions and interest from everybody who's watching this. That's John Burrello, the Senior Portfolio Manager at Invesco, and Reyna, the Head of Thematic and Specialty ETFs. Thank you both for joining us on this event today. I'm Ric Edelman, and we'll see you with our next webinar before too long. Thanks, everybody.